Hello, welcome again to Practice Problems for Chapter 15a. Okay, so here we are valuing an entity using the simple dividend discount model. So this is the perpetuity model, right? This is our perp model. This is where we assume that the entity under consideration is going to be lasting forever. And the other thing we might want to say here is that we're doing this for owners. Okay, whenever we do the simple dividend discount model, we're always doing it for owners. Let's see what I can do about that. There we go. So we've highlighted that a little bit. All right, so here's a problem very much like what you might see on homework or on the final exam. We have a company that is profitable, starting out debt-free, operating in steady state forever. So that's the key that's telling us that it's a perpetuity model, and we'll be able to use the perpetuity equation to find the present value of its free cash flows, things like that. Um, so we've got a private equity firm. We're thinking of buying it for 200 million, and we've done a separate analysis, which we'll learn about later, which leads us to believe that the optimum capital structure for the firm would be 60% debt to enterprise value. That's D over quantity, D plus E, where D is the total debt of the firm, and E is the market value of equity of the firm. Market value if you have it, and gap value of equity if you don't. So right now it's debt free. So if we buy it, we would recapitalize it so that it would have some debt and some equity instead of just equity and no debt. So here's how it would happen. If we buy the firm, okay, we're going to pay, this works out to 40% of the purchase price with our own funds, with the private equity firm's funds. And then what we're going to do is we're going to have the firm that we're buying, that'll be company X, right? Let's make that less confusing. Company X take out a loan at the moment of close to pay current owners the rest of the purchase price. So the 40% is going to come from us, and 60% is going to come from the company itself. So we're going to lever up the company to do that. So how do we pay the prior owners? We're going to come up with 40% of the 200 million, throw it in a wheelbarrow. We're going to have the company take out this loan for 60% of 200 million, otherwise known as 120 million, throw that in the wheelbarrow, and then we take the wheelbarrow to the existing owners of the firm. We give them the wheelbarrow full of money, which will be 200 million, and they give us 100% of the shares. And so now we're the owner. If we do that, we're going to operate the company in its recapitalized state. That's with the debt that we're going to have the company take out forever. Lucky us. Okay, so that's another feature of the simple dividend discount model. We assume typically we're going to own the firm, or the firm's going to live a happy life forever. All right, so now we have some given constants. Our risk-free rate here is given, and our equity market rate is given, and we have an unlevered beta for this firm of 0.8. And then one thing I've mentioned before, and I'm going to keep mentioning, is that if we have a given firm with no debt and we compute its beta, we get whatever we get. And then if we lever up that firm, we give it a bunch of debt, the beta of the firm is going to increase, and that it's going to be more volatile. And the reason that it's going to be more volatile is that it's riskier now, right? Because as we've levered it up, higher probability of bankruptcy, riskier firm generally means more volatile, as recognized in beta. And the way that I work that out mathematically is by using Hamada's equation with the CAPM model and all that jazz. But again, you don't need to know that. You just need to know that as a firm gets more leveraged, its beta volatility goes up. Okay, all right. So then let's go to the financing structure. So existing, the total capitalization of the firm, which is all the debt and all the equity, which we call cap tot, is 200 million. Okay, the weight of the debt, D over D plus E, is 0%. Dollar amount of debt, 0%. Dollar amount of equity is, of course, the whole 200 million. So after our purchase, in its as purchased condition, the total capitalization of the firm is going to remain the same, the total debt and equity, right? Because we filled our wheelbarrow still with 200 million to pay the existing owners, okay? But now the weight of the debt for the firm is going to be 60%, and that 60% is equal to, this is going to be equal to 60% times 200, okay? I'm about to let this go so you'll just see the result. So note it here, it's the total capitalization, 60% of that, and that's 120 in most circles. Okay, if the total capitalization is 200, the debt portion of that is 120, the equity portion of that has to be the difference between the two. So 200 minus 120, and that's 80 in most circles. So 80 plus 120 still equals 200. So total capitalization has not changed there. Okay, let's look at our key rates here. And one thing to note here, and we're going to see this more as we go on in the semester, is as we lever up a firm, the interest rate that the firm is going to be charged on its debt goes up here. And again, that's because the more leverage you have, the more risk of bankruptcy, the higher the interest rate demanded by banks and or bondholders. So this 6.75, what this represents, of course, they have no debt in this case. If they wanted to take out a very small loan, it would give them negligible leverage. Banks would charge them 6.75%. But if they lever up all the way to debt to enterprise value of 60%, then they're going to be charged a higher interest rate of 9%. Okay, income tax rate, the IRS does not care what your capital structure is, so your income tax rate is unchanged. And the cost of equity capital for the firm, which I've computed using CAPM. Despite all the bad things we know about CAPM, I have used CAPM to compute that because, why? Because it's easy to model. I know it's a bad excuse, but whatever. Okay, so with no leverage, its cost of equity capital is pretty low. And if the firm gets levered up, the cost of equity capital goes up. And that is because the beta went up there. And this should make sense too, that owners of the firm, if you have a more levered firm, are going to demand a higher return on equity capital as the firm gets levered up because it's riskier, more risk of bankruptcy, and shareholders, as we know, owners, as we know in bankruptcy, typically come away with nothing. So they're going to be very careful to expect a higher rate of return. Of course, this is not guaranteed for shareholders, right? These two are guaranteed unless the company goes bankrupt. These are in no way guaranteed. These are the costs of capital that owners would expect or hope for. Okay, so now we're ready to get the free cash flows for this guy. And so what I've got here is their most recent income statement. And remember, it's a steady state firm, so that's going to be the income statement from last year, this year, next year, except what? Except we're introducing some debt into the firm, so they're going to have some interest, and that's going to affect everything but the interest, okay? But we have the firm take out a loan for 120 million. That has nothing to do with the firm's revenue. So these two remain the same. Has nothing to do with depreciation expense. Has nothing to do with other operating expenses. And so therefore the EBIT here is going to remain the same at 27 million. Now, the interest is going to be very straightforward. This is going to be the interest rate, and we want their as purchased interest rate here, okay? Whoops, not our equity. We want our debt interest rate, not this one, right? Because this is as purchased. This is as we have levered them up. So I'll say 9.0% times what? Times the debt at the beginning of the period, well, it's a steady state firm, so every year the debt is going to remain exactly the same. So I can just take that 120, so times 120. All right, and that's the interest that they're going to have to pay. And just to keep my income statement consistent here, I'll make that a negative number. Okay, so then we can get to their earnings before tax. We just subtract the interest from the EBIT, and we get the earnings before tax here of 16.2. And now we can get the tax. Tax for us is always income tax rate times earnings before tax, where for those of you in the accounting police, this is very similar to taxable income on the tax return. So we assume that, okay? So we assume that earnings before tax is very similar to what they'll show for taxable income on their tax return. Okay, all right, so we can get the tax, which is EBT times the tax rate. So that's going to be 16.2 times, and their tax rate, I believe, was 35%. Let's just go up here and check it. Yep, 35%. So we'll say 35% here, okay? And I want to make that a negative number too, just to be consistent here, okay? And now we can get the net income. We just subtract our tax from our EBT, and we get our net income of 5.3. And from everything we talked about in great gory detail in the lecture for handout 15, in this case, if we're looking at free cash flow to owners and we have a steady state firm, as we showed in that lecture, the free cash flow to owners is equal to the net income. If we have a perpetuity kind of company, a company that's steady state forever, so our free cash flow to owners is just the same as net income for a perpetuity. Okay, so far so good. So now we are ready to finally value the firm. The purpose of this whole exercise has been to find the NPV and see if this is a good project for the firm. So that's what we've been working to. So I have a copy of our cost of equity capital down here just for convenience. And now I need to get the present value of all the future cash flows that we're going to enjoy as owners of this firm going out to infinity. And that just comes from our perpetuity equation, that the present value of all the cash flows of perpetuity are equal to just one of those cash flows, they're all equal, divided by the discount rate, which is the equity cost of capital in this case. Okay, so all I need to do is take my free cash flow up here and divide this by my cost of equity capital, and I get 102.3. And in our let me just grab these guys. In our as purchased condition here, the NPV of this project is going to be what are all the cash flows for us if we buy this firm? Well, the first one that we're going to have is a big negative equity, 80 million. That's what we pay the private equity firm out of our own funds to own this firm. So there's that. And then the only other cash flow is the present value of the stream of free cash flows that this firm is going to throw off once a year, and that's 102.3. So what we want to do is take here all our positive cash flows, and we want to subtract the price we would have to pay now to enjoy all of those beautiful cash flows, and we get 22.03, and this is greater than 0, so model says go for it. Okay, now while we're at it, another thing that's nice to do is to look at the NPV per dollar of our own funds invested, the NPV to owners per dollar of our own funds invested. So let's go ahead and do that. Okay, so we're going to take our 22.03, divide that by 80 here, and we get 27.5. So we'll have a return of 27.5% for every dollar invested in this of our own money, which is pretty cool. And also, just FYI, over here, I went ahead and found the NPV. This would be assuming that we didn't recapitalize the firm, so we just went ahead and bought the firm with no debt. And here's the NPV, which is bigger, but remember we coughed up a lot more money to get that. So in the case if we didn't lever it, our NPV per dollar invested would only be about 22%, and with leverage, our NPV per dollar of our own funds invested goes up to 27.5%. So as we've said before in the class, it's true, it's really true. If a project is worth doing, it's worth levering. Okay, that's it for this problem. We'll pick up with another problem in just a second. Okay, so here's another example of entity valuation, very similar to what you might see in homeworks and on the final. This one is using our buy, manage, sell model, and we are going to be evaluating the entity to owners, not to all stakeholders. So let's see what we've got here. Actually, before we do that, let me just remind you the buy, manage, sell model. This is where we're going to purchase a firm. We might or might not recapitalize it along the way, and then we're going to manage it for 1 year, 2 years, 3 years, 4 years, and then plan to sell it at the end of that time. So typically the strategy will be either that we're buying in a recession and we're going to manage the company and sell it when market conditions are better, or we're going to buy a company that is poorly managed and will increase its free cash flows, and then it'll be a more valuable company and we'll sell it at that point. Okay, so let's see what we got with this particular example. We've got company Zebra. It's profitable, debt-free, and it's operating in steady state forever. Okay, that's good because that's going to give us those great accounting simplifications. Okay, despite this, right now, which in the real world is also true, the economy is in recession, which has depressed the price of Zebra's stock. So you've got a private equity firm and you're considering buying Zebra at the asking price of $100 million, and this corresponds to a PE ratio for the company of 7.69. And remember, the PE is equal to what? The market price of the equity divided by the net income, if we're talking about it at the whole firm level. So let me put ratio in there. Okay. All right. So your firm believes that you've done a different analysis, or your boss has, somebody at your firm has already done an analysis saying, if it's worth buying this firm, it's worth levering it for any financial project. If it's worth doing, it's worth levering. And that analysis showed that probably the best amount of leverage for this firm to have would be 45% debt over debt plus market value of equity ratio. Okay, and right now it's debt free. So if you buy it as part of this move, you're going to change that capital structure. So the firm will have some debt going forward. And that's what's talked about here in the next couple lines. If your firm buys, you're going to buy a Zebra. You're going to pay, this works out to 55% of the purchase price from your own funds. So that'll be 55 million because the asking price here is 100 million. And then how are you going to cough up the rest of the 100 million that the current owners want? You're going to have Zebra take out a loan at the moment of close, okay, and the proceeds of that loan are going to be combined with your proceed and turned over to the existing owners to get 100% of the shares. So that's how it would work. So the 55 million would come from you, 45 million would come from the loan that Zebra itself takes out, not your private equity firm, but Zebra. Okay, so this would be a classic example of a leveraged buyout, right? Okay, so then what else would you do? You would operate the company in its recapitalized steady state. So you're going to keep it steady state. You're not going to go into new markets, do anything silly. So it'll keep operating in steady state for 2 years. At the end of this time, at the end of 2 years, after you've got 2 years worth of dividends, hopefully free cash flow dividends, you're going to sell Zebra, okay? And why are you doing that after 2 years? Because that's when you believe the PE ratio will have increased, that market conditions will have gotten better, and therefore the firm will have a higher PE ratio, and you think it's going to climb all the way from 7.69 to 9.6154. And you can ask me why I have 5 significant figures for that PE ratio, and I won't quite answer that. Okay, so that'll be a mystery. It's an unimportant mystery, by the way. Okay, so what do we want to find? The CFO of the private equity firm says to us, find the NPV of this project. Should we go ahead and buy this firm, recapitalize it as envisioned up above, et cetera, et cetera. So happily, the CFO has given us some stuff, risk-free rate, market rate of equity, and the beta for this firm, for Zebra, okay, in its unlevered state, 1.1, and beta levered comes from our Hamada's equation, et cetera, but we don't need to worry about that. But again, the beta levered gets bigger, that increases the risk. And when we put this into our CAPM equation to determine the cost of equity capital in its levered state, this is going to drive up the cost of equity capital, RE. So that's why I bothered with that. This, again, is not something I'm asking you for. I'm just presenting it to you as part of the analysis that your CFO has started. Okay, so what's the financing structure and what's it going to be? So the total capitalization of the firm is all equity right now. It's 100 million. Okay, debt is 0%, weight of debt 0%, debt is 0. The entire capitalization 100 million. It's all equity. Okay, and after we purchase it, it's going to be different. The total capitalization, debt plus equity, is going to be unchanged, okay, but 45% of this capitalization is going to be debt in the form of the loan that's taken out by Zebra at the time we purchase the firm. Okay, so the D is going to be equal to 45% times 100, okay, and that's 45 million. And the equity here is going to be RE. If our total capitalization is 100, it's going to be equal to 100 minus 45, okay, or 55 there. All right, so let's keep going. So happily, our CFO of our private equity firm has given us some more information too. She's gone out and done a lot of work and determined that if the firm took out a very small loan in its unlevered state, it would be charged by banks about 7% interest, but with a lot of debt, okay, with 45 million of debt, it's a riskier firm. Banks are going to charge higher interest, so its pre-tax cost of debt capital is going to be move up from 7% to 8%. Why? Because in its as purchase state, it's riskier, right? It's got that debt, higher probability of bankruptcy, okay? And the same thing is true with cost of equity capital. And again, I got these costs of equity capital from CAPM, as we say over here too. So if the firm is unlevered, the cost of equity capital should always be higher than the pre-tax cost of debt capital, because even if a firm is unlevered, if it goes bankrupt, the shareholders are pretty much going to be wiped out. And as we lever up the firm, it's still true that the cost of equity capital should be higher than the cost of debt capital, and it should also be much higher than the cost of equity capital if the firm is unlevered. It's higher than unlevered because more risk of bankruptcy, and shareholders typically get nothing, okay? And it's always higher than the cost of debt capital because in this levered state, for example, if the firm goes bankrupt, the debt holders will get something. Shareholders typically get nothing in bankruptcy. So they demand a higher return because of that truth. Okay, income tax rate, the IRS does not care how you're capitalized. Your income tax rate does not change as a function of your leverage. Okay, so now we can work on getting the free cash flows. Actually, let me jump ahead a little bit here. The NPV, we're asked to find the NPV for this project. So for this particular project, The NPV we need, what's the NPV? It's the discounted value of every stinking cash flow for this participant for this project. So what are the cash flows for us? So first of all, we pay what we pay for the firm. Our contribution is going to be that 55 million. Okay, then we're going to get the free cash flows from managing, operating the business, and we've got them for 1 year. Okay, and then we've got them over here for 2 years. Okay, so distributive property of multiplication over addition, you see that works out to our 2 years of free cash flows. And then the final cash flow is we're going to sell this firm, right? And we're going to get our sale price to owners, and we have to discount that back to t equals 0. So that's everything that goes into our NPV. So we already know how much money we've put up. Here's our PP, purchase price for equity, 55. So next up is we want to know what are the free cash flows that we're going to get for the 2 years that we're managing this firm. So I've got here the existing income statement, and I've got here a partial version of our as purchased income statement. It's a steady state firm, remember, so it's been getting revenue of 110 for a couple years. It's going to keep getting that forever, and that revenue is not gonna change just because the firm has been recapitalized. Same thing with depreciation, it's not gonna change. Same thing with our other operating expenses. So our EBIT is gonna be the same whether or not the firm is levered. But now when we purchase it, now the firm has this loan, right? And so we're going to have to pay interest on that loan. So the interest on that loan is going to be the pre-tax cost of debt capital. There, our interest rate of 8%, and that's going to be times the amount of the loan, okay? And it's steady state, so that amount of the loan is forever, so that's pretty straightforward. So we get our 3.6 for that. And to be consistent with the rest of this income statement, I'll make that a negative number, okay? So now for tax, remember tax is equal to tax rate times EBT. So what's our EBT? We don't have a line for it here, but we know that it's interest, it's EBIT minus interest. Okay, so I'll say equal to our tax rate, I think is 35%. I'm going to point to it up here. Okay, our tax rate times this guy plus this guy. Okay, and that's 5.74. And again, just to be consistent with the way I've been doing this income statement, all the expenses are shown as negative, so I'll make that negative 5.74. Okay, and so now I'm ready to get my net income, which will be my EBIT minus my interest minus my tax. And so I'll sum those up and I get 10.66. So our net income is down if the firm is levered because we are paying this interest. But remember, the beauty of that interest is we didn't have to pay 100 million to buy this firm. We only had to pay 55 million. Okay, now we all remember that for a steady state firm, the free cash flow to owners is the net income. But I just want to walk us through the more general case. In general, remember, we learned that the free cash flow to owners in any given year is equal to the net income in that year minus changes in working capital plus depreciation, because that was a non-cash expense, minus capital expenditures, and plus any changes in the debt. Okay, so if it's a steady state firm, the changes to working capital are 0. We don't have to increase accounts receivable, accounts payable are not going to change because it's steady state. Okay, if it's steady state, our depreciation is going to be, well, in any case, the depreciation here, when we add it back to get our cash flow from operations, it's got to be the amount shown on the income statement. So that's still our 60 here. And then our cash flow from operations will be equal to our net income minus our changes to working capital, and then plus adding back that depreciation. So we get 70.66. Okay. If we have a steady state firm is characterized by having its capex equal to its depreciation. Okay, so even though we have free cash flow from operations of 70 million and change, we need to spend 60 million on CapEx to maintain our equipment and our trucks and all that stuff. And the change in debt after the purchase at t equal 0. After we've recapitalized the firm at t equals 0, there are no further changes in debt. So that's going to be still equal to 0. So what's our free cash flow to owners? It's our net income minus this plus that minus that plus that, and you add it all up, and you will agree with me that if it's a steady state firm, the free cash flow to owners is, it's really true, is just the net income. But it's really good to know how we got there, and it is good to know that this is the general equation here, which is a good thing to know in general. If we didn't have a steady state firm, then we would have changes in working capital. Depreciation would not match CapEx, and we may or may not have any changes in debt. Okay, so this is the free cash flow. We're going to get 2 years worth of these free cash flow. How are we going to get these as owners? Dividends. These are going to come out as dividends. Okay, and now I think we're ready. I think we have everything that we need to find the NPV. So this is our goal, is get that NPV, and all we really have to do is work out this equation numerically. So we have the price we paid for the firm. We've got that first cash flow. Now we have our free cash flow to equity, and we're going to get that twice, right? Because we're managing this firm for 2 years. End of year 1, end of year 2, we get that. And we've got to figure out the sale price, okay? So the sale price, we should be able to figure out from the PE ratio. So this is going to be in 2 years in the future when they think the market has improved. So let's see if we can figure that out here. Okay, so we get S from PE ratio. Okay, so we have market value of equity divided by net income, and we take this whole thing, so that's our PE ratio, right? And we're just going to multiply that PE ratio by the net income that we get, and that's going to be it. So let me put this another way. So S is equal to PE ratio times net income in year of sale. All right, so let's see if we can figure that out. So that's going to be, we go up to, we know our PE ratio in the year of sale. That's something that the CFO has estimated for us. So we want to multiply that by the net income in the year of the sale. And it's a steady state firm, so every year's net income is the same. So we go ahead and do that, and we get that the best estimate of the sale price is 102.5 million. All right, and so far so good for that. And now let's see, I think we have everything we need to compute our NPV here. Let's see if we can do it. So we're going to start with minus the amount we paid for the firm, okay, and then we're going to get plus, let's take this free cash flow, we're going to get 2 of those times 1 over 1 plus, and I want to use my equity cost of capital here, okay, and I want to be sure to use the as purchased version, right, because we're managing a levered firm. I don't want to use my 7.9%, I want to use my 10.424%. Okay, so the first cash flow gets discounted back by 1 year, and then we're going to have another one which is going to get discounted back by 2 years. Okay, so those are our free cash flow dividends discounted back to t equals 0. And then the last thing that I've got to put in here is the sale price, and that has to be discounted back by 2 years also by the equity cost of capital, which is in cell E45. Okay, and I think that's good. Let me do a quick scan here. Yeah, I think that looks good. Let's see what happens. Whoop! Oh, as always, I have a typo in there. So let's see what it's not like. And that's one thing that it's not like. And that's for sure. Okay. All right. Okay, sorry about the typo. And here's what we get from that equation, 47.78. And this is greater than 0, meaning this model says go for it. And it's important to remember that it's just this model that's saying go for it, right? We have so many assumptions and bad things built into this model. You know, is the firm going to be steady state? CAPM is generally not the greatest thing for estimating cost of capital. I mean, there are tons of assumptions like that. But this is certainly a lot better than doing nothing. And that's a pretty high NPV. So we probably have a pretty big safety factor there. So that's how to solve this type of problem. This is actually pretty realistic if you are wanting to do a quick and dirty valuation of a company for a private equity firm or anyone who's thinking of buying a firm, running it for a short period of time until market conditions improve, and then selling it. It's helpful to just say, okay, the company is going to be in steady state. It's just a couple years, et cetera, et cetera. So this is really not a bad back of the envelope model to use in a situation like this. Okay, and with that, I think I'll end it here and see you back again hopefully sometime soon.